What if I told you that while the world was distracted by Christmas lights, family dinners, and holiday travel plans, something extraordinary happened deep inside the financial system? Not a cyber attack, not a market crash, but a carefully coordinated regulatory strike, executed in the quietest hours of the year when markets were at their weakest. This wasn't speculation. This was official, documented action. And what it reveals is far more disturbing than simple market control. On the night of December 23rd, just minutes before Christmas Eve, global silver markets were technically open, but functionally abandoned. Banks were closed. Wire transfers were frozen. Liquidity was nearly non-existent. At 11:47 p.m. Eastern, the first move landed. The Chicago Mercantile Exchange announced an emergency margin increase, not gradual, not phased in, but a massive 75% hike, effective immediately. Then came the second strike. The CFTC imposed sudden position limits, capping holdings at 5,000 contracts per trader. And finally, COMEX issued warnings of potential trading halts under extraordinary market conditions. 3 agencies, 3 different weapons, all deployed within a 163-minute window in the dead of night. According to data referenced by the Bank for International Settlements, nothing like this level of coordinated intervention has occurred since the 1980 gold crisis. Most people think the story started on Christmas Eve. It didn't. The real experiment happened 11 days earlier, on December 12, 2024. Silver surged past $65 per ounce, breaking every modern historical record, higher than 2011, higher than the Hunt brothers era, higher than anything traders had ever seen. Within hours, margins were raised without warning. Silver fell nearly $5. Most traders assumed that was the end of it. It was. Exchange data shows that move was a stress test, regulators measuring how much pressure the market could absorb. What they learned scared them. Because silver didn't collapse. It stabilized. And then it started rising again. Here's the key question no one in mainstream media is asking. Why impose emergency midnight controls when silver wasn't exploding? After December 12th, silver traded calmly around 60-61 for nearly 2 weeks. No mania. No runaway volatility. So what were they really protecting? The answer isn't in price charts. It's buried in physical supply data. According to the Silver Institute's World Silver Survey, the world has been running continuous silver deficits since 2021. By the end of 2025, those deficits total approximately 820 million ounces. To understand how serious that is, global annual silver mine production is about 830 million ounces. In just 5 years, the world has consumed the equivalent of an entire year's global supply beyond what mines could replace. And that silver didn't disappear into vaults. It vanished into solar panels, electronics, medical devices, EVs, data centers. Once silver enters these applications, it's gone for decades. COMEX registered silver inventories currently sit near 73 million ounces. Yet futures contracts represent claim on hundreds of millions of ounces. This system only works if physical metal can be sourced when delivery is demanded. But here the problem. Industrial buyers aren't speculators. Solar manufacturers don't roll contracts. Electronics firms don't cash settle. They take delivery. And they don't give the metal back. Every single day, roughly 2.4 million ounces of silver are permanently removed from circulation. In early December 2024, COMEX silver futures began trading at a $1 premium over London spot prices. That is not normal. In healthy markets, that spread is a few cents. A $1 premium is a distress signal. It means physical buyers are willing to pay almost anything to guarantee delivery. That was the real trigger. Margins didn't rise because of speculation. They rose because metal was getting hard to find. Unlike oil or wheat, silver production cannot ramp up quickly. Why? Because 70% of silver is mined as a byproduct of copper, zinc, and lead. Copper miners don't care if silver hits $100. They expand based on copper economics. Primary silver mines account for less than 30% of global supply, and they're already operating near capacity. Even triple-digit silver prices wouldn't solve this shortage. Consider just one sector, solar energy. 2015, million ounces used. 2024, 232 million ounces. China alone installed 216 GW of solar capacity in 2024. Each gigawatt requires roughly 50,000 ounces of silver. That metal will sit on rooftops for 25-30 years. And solar is only one piece. AI data centers, EVs, 5G networks, medical technology. Silver is everywhere and irreplaceable. If deficits continue at current rates, the world crosses a 1 billion ounce shortfall by late 2026. At that point, COMEX inventories represent less than 1 month of global industrial demand. That's not a buffer. That's a countdown. And regulators know it. The Christmas Eve intervention wasn't about order. It was about time. Time to delay price discovery. Time to prevent delivery panic. Time to keep paper markets functioning while physical reality catches up. But here the problem. You can't regulate metal into existence. And you can't suspend physics. Every day, silver leaves the system. And it doesn't come back. Up until now, we've talked about shortages, deficits, and emergency regulations. But to truly understand why regulators panicked on Christmas Eve, we need to look at how the silver market is actually structured, and why it becomes dangerously unstable when physical supply disappears. Because silver isn't just traded. It's promised. In the futures market, every silver contract represents 5,000 ounces of metal. On paper, the COMEX silver market trades billions of ounces per year. But here's the uncomfortable truth. Most of that silver does not exist in deliverable form. It never has. The system assumes that only a tiny percentage of contracts will ever demand delivery. Most traders roll positions. Some cash settle. Others exit before expiration. The market works until it doesn't. Industrial users don't play futures games. They don't roll contracts. They don't speculate. They don't accept cash settlement. When they buy futures, it's because they can't source physical metal elsewhere. And that's exactly what began happening in late 2024. According to COMEX delivery notices, industrial demand for physical settlement surged after November. Registered inventories kept falling. And suddenly, the ratio of paper claims to physical silver reached levels that should never exist in a healthy market. Some estimates place the leverage at over 300 paper ounces for every real ounce. At that point, price becomes irrelevant. Confidence is what matters. And confidence was cracking. Here's something retail investors rarely hear. The biggest risk wasn't traders. It was clearing members and bullion banks. If just a small percentage of contract holders demanded delivery simultaneously, the system faced forced cash settlements, emergency rule changes, or outright default. Any of those would destroy trust in commodity markets globally. Once that happens, the damage spreads beyond silver. Gold, energy, food commodities. The entire derivative system depends on belief. And belief is fragile. When regulators panic, they don't start with trading halts. They start with margin hikes. Why? Because margin hikes don't target physical demand. They target speculation and leverage. They force hedge funds to liquidate, smaller traders to exit, volatility to collapse. But margin hikes do nothing to stop a solar manufacturer from demanding metal. That's why the December 12th move failed. And why Christmas Eve was different. The timing wasn't accidental. Christmas Eve was chosen because banks were closed, wire transfers were frozen, liquidity was near zero, most desks were unmanned. Even traders who wanted to add margin physically couldn't. Positions were trapped. Liquidation became inevitable. That's not regulation. That's tactical containment. To the public, the agency said, extraordinary market conditions. To insiders, the message was clear. Do not push this market further. It was a warning shot. Not at speculators. At anyone thinking about forcing physical delivery. Some argue that higher prices will unlock recycling. That sounds logical. It's also wrong. Silver recycling is slow, expensive, and inefficient. Electronics recycling recovers tiny fractions of silver. Solar panels won't be recycled for decades. Medical and industrial silver is often unrecoverable. Recycling might add 150 million ounces per year at best. That doesn't close a 300+ million ounce deficit. It barely slows the bleeding. Could industries switch away from silver? In theory. In reality, no. Silver has the highest electrical conductivity, superior thermal performance, proven long-term reliability. Copper overheats, aluminum degrades, synthetic alternatives fail under stress. In mission-critical systems, data centers, EVs, medical devices, failure isn't acceptable. That's why engineers don't compromise. They pay. History tells us something important. You can suppress price temporarily. But once physical scarcity becomes visible, control fails violently. We've seen it before. Nickel in 2022. Energy in 2021. Food commodities during global shortages. Silver is following the same pattern, but with one key difference. It's essential to every future technology. Right now, this is still a quiet crisis. Most people don't follow COMEX inventories. They don't read refinery reports. They don't understand delivery mechanics. But that won't last. When electronics prices rise sharply, solar installations slow, EV costs spike, people will ask why. And the answer will lead back to silver. Once mainstream investors understand that silver is just another commodity, demand changes character. It stops being speculative. It becomes strategic. That's when ETFs struggle to source metal. Coins disappear instantly. Premiums explode. And regulators lose their remaining tools. When regulators act in silence at midnight during the least liquid window of the year, it's not confidence. It's fear. The silver market didn't break on Christmas Eve. It revealed the truth. The only real question now is, will you recognize that truth before the rest of the world is forced to?